Hello guys, my name is Alejandro Zambrano and I'm the Chief Market Strategist with ATFX UK. And we're going to talk a bit about my Q3 market outlook. We published these already in June, but it's time to do a little follow-up on these reports. So that's why we are hosting this webinar. It's also always interesting, of course, to talk with you guys, answer your questions, and see if I can help you guys in your trading. Now, I've been trading myself since 2016, so I have quite a great amount of experience trading the markets, and I'm quite good at it as well. So hopefully I can take some of my skills and channel this to you guys to help you guys with your trading. All right, good. So we will get going, and I'm going to start out by sharing my screen with you guys. And I actually started, or for this Q3 market outlook, I wrote the outlook for the EURUSD and the pound versus the dollar. And that is what we're going to focus on. Of course, if you guys have any questions, if you want me to take a look at any other markets, then we can do that. But let's begin with what I said in the Q3 market outlook. Okay, so this is the Q3 market outlook, and obviously when you're working with a big team, like here at ATFX, we have a significant amount of analysts. It does take a bit of time to compile it. So what happens is that we actually compile it almost 1 month before they're being published. Here's me, Alejandro Zambrano. I'm the Global Chief Market Strategist. There's my colleague Martin Lam, which is the Chief Market Analyst or Chief Analyst at our Asia Pacific division. We have Dean Shen, which is a Senior Analyst and based in China. And then we have Jason T, and 𝐦𝐧𝐯𝐞𝐬, and Cameron, which is our Senior Content Manager. So all these are analysts. Cameron here, he has been trading for a long time as well, before focusing on sort of the content we produce here at ATFX. So we have a quite big team, and we try to bring all these different voices because these are from different places, these the different analysts. Again, there's Hong Kong, mainland China, and I think as well Jason is in Hong Kong, and I'm so bad with locations, but I think Jessica is based in Southeast Asia. I don't remember exactly where. And then we have Cameron and myself, which are based in London. So let's begin then with my parts then. So my general view was that in June that traders and currencies and the stocks on the way down, they all panic, right? Like coronavirus is gonna be the end of the world, and we're never gonna come back from it. Everything gets extrapolated. That's what investors always do. But we know now that that's not really the case. The situation is okay to some extent, especially in Europe, where things have gone in the right direction. And then you have potentially a vaccine coming up. I mean, that would be super helpful for something like a place like in the US, which is now facing a second shutdown. But overall, we survived. Things are calmer now. Maybe things are gonna go bad again, but realistically, it's gonna be okay. Even with the Spanish flu in, what is it, 1918 or something like that, you had a World War I going at that point, so it was difficult to sort of say, all right, we're gonna try to limit this. And you had all that, and even then they survived. After 2 years, some 40 million people died back then. Of course, there's a big difference, but people survived. And what's interesting is that back then it was the younger working population that was dying. And from an economic point of view, that is bad, because if you end up in a society where you have much more elderly that are not working and not paying taxes, the same as they used to do when they were working, unless they're savings, then you're gonna have an issue. And of course, we all know that nowadays most government has some sort of debt. In some places, like in Italy, they're like I think more than 100% of GDP. So of course, if all the young people of Italy would die and you only have the elderly left, then you would have a huge problem, But that's not the case now. Now it's actually the other way around. The elderly population is getting hit the worst, and that is, again, from a purely economic perspective, better than what happened in the Spanish flu. Long story short, though, on the way down, I thought people were overreacting, and now they're overreacting on the way up. And when I did this report, I thought they would come to some sort of consensus, but they didn't. So my general view was that we're going to see EURUSD go up, we're going to see pound dollar going up, and we're going to see stock markets going up, but people are going to temper themselves. You know, if you have been following something like the Nasdaq 100, then clearly they have not been tempering themselves. So this is the Nasdaq 100. This is a daily chart, and from the very low here, you can see that we're up with 67%. So no tempering here at all. If you look at something like the EURUSD, which we're going to do in a few minutes, we went from a very low level all the way up here to well, 119. So that's 1,291 pip. Now, my general idea was that we're going to stop here. So when I did the webinar, the recording, or when I wrote this article, it was around June, the beginning of June. So we were here and somewhere here, and I thought we were going to stop there. And why did I think like that? Because let's examine actually why I thought it was going to be like that, because these drivers are important and they will come back. And, at one point people will say, well, of course, it's supposed to be like this, that I can tell you that. So let's take a look at the first point then, the EURUSD. My argument was that the USD advantage is gone. There's no big difference between interest rates in the US or Europe, right? And that would keep things in check. As well, on a relative growth perspective, so who's going to grow faster, EU or the US? I think as well here, I said the US is probably going to have a bit of an edge, but again, I don't think there will be like a huge difference between the countries, and that again would limit, and I still think it will limit eventually. So let's examine the first point. So this is the ECB interest rate. So you can see it's already been at 0%, right? So this one was lowered, I think, already here in 2015 or something like that. That's when it started to reach 0, and then it has been at 0 for a long time. In the US, if you remember, from 2015 or so, the interest rate was going up, and it reached some 2.25% or something like that. And that meant that you could borrow money in Europe for 0%, and then you could invest this in the US, and you would get about 2%. You might say, I don't care about 2%. Yes, but if you're a big pension fund, you do care about 2%. As well, you're not investing in something crazy, you're just investing them and putting them with the central bank of the US. Now, if you get clever with it, you can use leverage. So imagine you take, 5 times leverage. So you borrow for, you just to give you a simple example, you take 20,000 euros, and then you go to a bank and you say, look, I want to borrow 100. Here's 20. And then they're going to say, okay, we'll keep you 20 here. We'll borrow you the 80. We'll borrow you the 100. And of course, if you lose, we'll keep the 20 and we claim back the rest. So take these 100,000 and invest them in the US, and the difference here, effectively, you would multiply whatever you're doing here. So instead of just making, if you have 2 times leverage, instead of making 2%, you make 4%, and so on and so on. If you do 10 times, you get 20%. 20% is a really good return. Of course, with that comes higher risk. But the key point is this: the yield is now 0 in the US, exactly as it is here in the euro area. When no central bank is doing anything, like when the interest rates are pretty much the same level, there's little incentive for people to buy or sell, okay, the currency. Now, what else? What also determines the value of a currency? Well, relative growth. So this is how the US economy was influenced on the back of the coronavirus crisis. So on the second quarter of this year, compare what was produced from a GDP perspective, compare with last year. Well, the US economy lost 9.5%. Let's take a look at the euro area. the euro area lost 15%. That's a third more than in the US. So what does this actually mean? It means that on an economic perspective, the euro area did worse. So just from these numbers, does it make sense that the euro should be trading up here at 118? No, I don't think so. And that is why I was bearish. So I had a general idea that we should be selling here if possible. When I did the analysis, it was at 112.36, the euro USD, and we were heading towards the 2020 high. As you can see here, I say I remain bearish below this level. So my general idea was to sell if I could. So I'm looking for a reversal there. And we did have a reversal for a while in the euro USD. Like you can see how the market went up, then the market went down, and the market went up. And maybe on the way up here, one could have sold. And actually, on a short-term basis, I was bearish here for a few days. But then when the price took out these levels here, it was time to turn bullish, which is only the right thing to do because you don't want to fight against the trend. But again, if we look back at things, interest rates are low in the US. They're low in the euro area. GDP, from an economic perspective, the US is being hit less hard than the euro area. So realistically, this is not going to continue to gain and gain. It's not going to go to 125. Ultimately, maybe we'll come back to 112. Are we going to break much lower? I don't think so. Realistically, over the long run, we'll trade sideways between something like 103 and 125.91. So how can we explain this then? Why are people suddenly, instead of stopping price here at 112, because we did stop at 113 and then we did go down to 112, why do we continue to go upwards? It's because of a failure of the US government and the US states to contain the coronavirus situation. All right. So you have, let me just, these are a bit annoying, they move off too much. So what's happening here is that at one point, cases peaked in Europe, in Italy, in these places. They did really good, right? And we saw a peak as well in the United States of America. Yet, in the southern states of in the U.S., they started to open up again, and they were all being warned about the situation. But people sometimes can be stubborn. Like if you look, for example, a very good example is the Brazilian president, which many times have compared this with the normal flu, and even the President Trump has done similar analogies in the past. And obviously, if you have that mentality, especially in the south well, not so especially in the south, but in the Midwest and the south parts of the US as well, they had similar mentality. Then, if you don't force close down, and what they did, they open up really quickly. That's really what they thought. The problem is this, though, with the US. There's millions of people that don't have right or access to hospitals, right? And it's not like in Europe where you're sick. If I go sick, if I get a heart attack now, or I have problems, I can go to the hospital and I won't pay nothing. And if I need to be there and I need to be there for the rest of my life, I don't pay. In the US, if you get COVID-19, you get on the ventilator, you get this, you get that. Before you know it, you have a bill of $20,000. The average salary in the US is like 25. So suddenly you're at risk of losing all of your income. And not only that, for 1 year, and not only that, you could effectively, you be out of work, so you don't make any money. Number two, you need to pay people. Number three, you might die. So what happens in these places is that people themselves, they want to isolate. They don't want to do business. They want to save. And that is what didn't work out in the US. They got this increased amount of cases, and because they opened up too quickly. Now we're starting to see a bit restrictions. We've seen this coming down a bit. Luckily, from a human cost perspective, we did see a limited amount of deaths. So these are the deaths. So on the way up, there was a huge amount of people that died. And I reckon because people are now better prepared and it's a different generation, it's not so many elderly that are getting sick, and the elderly themselves, they know to take it easy and hide, then they don't have so many deaths. To give you an idea, my father, he lives in Sweden with my mother because I was born and raised in Sweden. He's 66 now, and he barely goes out. He lives, they live as well in like in a suburb, so, and Sweden is not densely populated anyway, so he can go out and so on, and he's not gonna meet anyone really if he doesn't really want to. It's easy to avoid. Like if you step out of the house where I was brought up, you know, there's neighbors and everything, but you know, if you want to, you'll have 15-20 meters of distance to the next person, so it's not a huge issue. But still, people don't go out and they don't consume. And that is what is influencing things here. Now, if we'll take a look at the situation in, let me see, I'll press the wrong button. If we take a look at in Europe, it's not really the same situation. And, you know, people are going on holidays. People are going to places like Spain, France, Greece, and so on. Of course, the situation is different, right? It's not like before. And in the case of Spain, they used to be in the top section here. Now we need to scroll. There we go, number 9. This is Spain. Let's see if we can find France. France is number 20 now. At one point they were much higher. Let's find Italy. Italy is in place number 16. So let's begin with Italy. So things are picking up, but it's not a huge amount of people. 384. That's not particularly high, is it? It's not like it used to be. And then this is Spain. Here things are going badly, and this is where you need to keep an eye on. You see, in Spain they opened up, I guess, too quickly. They had things under contained, but then things quickly escalated, and you can see how things turn really nasty fast. Here's France, and there things are picking up, but it's not picking up as aggressively. So we're at an interesting situation where I think, at least initially, you had a situation with initially here. Sorry, got a bit distracted. You have a situation here where the U.S. has been dealing with this in a bad way, and I have a situation in Spain. UK now is being much more proactive here, and they limit things. Let's actually take a look at the UK. And obviously, you know, when your own prime minister, because I'm based in the UK now, your own prime minister gets it, the disease, he's gonna be super cautious. So hopefully we will limit things, and they have been able to limit things. So what's gonna happen next? When it comes down to investing, it's always about the relative positioning and relative risks. Again, interest rates, they're flat. QE is going to be about the same, ECB versus the Federal Reserve. Relative growth, for now it looks like they're pretty much, the euro area is a little bit more badly damaged, but now third quarter numbers are probably going to be a bit better maybe in the euro area compared with the US. But ultimately now what's happening is that if things spiral out of control, it does look like Spain would need to go and shut down again if you look at those numbers. And if we see things they're picking up, for example, in France, suddenly you have an issue. And at the same time, things are coming down in the US. So that is what I will be focusing on. I think that is what eventually could limit things. So here's my original analysis for this market. Now let's just clear that out. So let's try to apply some technical analysis to this. So you have this level up here, which is the high from June 2018. And we can also apply some Fibonacci to this. And we can do something like that. Okay, so Fibonacci just gives you these 3 different levels. And in a downtrend like this one, from here to here, it was a downtrend. you will usually see the price stop at the 61.8 to the 50 or 38.2% level. So we are at these levels right now. We did try to take out that level, and if we indeed manage to take out that level, we're probably going to push higher. Yet, if we are capped by this level, I think we will probably come down here to around the first fib level, and then we'll see if it's going to go all the other way around. What's going to push this to go all the way around? It is if the euro area finds itself back where it was when everything started, and the US suddenly starts to outperform. But I think realistically, I would look for a long-term perspective, I would look for another high hit. And as well, if you look at the daily chart, you can see this is the RSI. The RSI is, you get a double top on RSI 14, actually have a triple top. So it's as overbought as it was here and here. Now, it did good the first time, it didn't do good the second time. Maybe it's gonna do good the third time. If you look at this from a weekly perspective, it's also overbought. Now, just because it's overbought doesn't mean that it has to stop. You see here the situation was overbought, and we went up, and then it went down, and then we went up, and then you have some divergence here. Divergence is when the RSI is lower than this one, and the market on the other hand create a higher high. So what's the plan here going forward? The plan here going forward is to, for now, remain bullish. Yet, keep an eye on the series here of higher and higher lows. So this is a 6-hour chart. So this is the area where I think the euro could come back to at one point. So for now, the price is indeed creating higher and higher lows. And we could have a situation where we head higher. This by itself is a double top, yes. And we could potentially, if you look at it from this perspective, this is my main scenario, we could go upwards like that. But when we take out these levels, eventually I do anticipate a reversal to happen. You might say, all right, how are you gonna keep track of this then? You can keep track of that low, but even better, on ATFX YouTube channel, I produce analysis, and I produce this 3 videos a week at least. Sorry, 2 videos a week at least. And in the chat, there you go. That is the link to that. So I do these market updates on Monday and Thursday, where I do cover the EURUSD. You're also gonna find these different interviews I'm done, and different educational content that we produce as well. So you really want to keep an eye on that. And as well, I'm on Twitter at the handle AlexFX00. Let's see if I can send that to you. Again, very good to keep track of me there, what I'm up to, because I provide these hints and ideas. All right, so that is the outlook for the EURUSD. Again, the way this is looking right now, from a relative industry perspective, relative growth perspective, I think industries are going to remain relatively flat, so there's not going to be a yield advantage. There's not going to be any advantage from a growth perspective. And what we're seeing now is we're going up because the US is handling things badly. But US is getting things under slightly control, and on the other hand, things in Europe are going a bit out of hand. Now, I do think they're probably going to be very careful here and try to limit this. The problem, of course, is that economic activity is going to remain low for longer. Like in the UK, for example, where we shut down massively in the second quarter, the UK GDP economy was 22% lower than it was last year, which is a huge drop. And a big problem with this is that the longer we keep things shut down, these small businesses that depend on people coming to their shops, they're going to go bankrupt. And then you can have secondhand problems, like the housing market starting to topple because people can't pay their mortgages and so on. And that can become an issue. And that is obviously something that came from stock markets ultimately. But for now, everybody's in their head seeing, all right, look, Europe beat it. We're going to have a vaccine. They printed all this money in the US and Euro area. So people buying gold, people buying stocks, people selling dollars. But now, see what's happening in Spain. The trick is here, are we going to get a vaccine, or is the situation in Spain and Europe going to deteriorate? don't really know exactly, but I can tell you from a technical perspective and everything I just mentioned, I don't think EURUSD is gonna just continue to rise up and and reach the moon, so to speak. Okay, good. Do you guys have any questions on this? If not, we're gonna continue and we're going to take a look at the GBP versus the USD. We have a few people here. Don't be shy. Most welcome just to put a question in there. As well, I'm sending you a link here. It goes to my meeting planner and it's quite straightforward. The meeting planner looks like this, and we do offer free consultation, a 15-minute consultation. And the idea with this call is see if I can help you in any way to, you know, get you guys quicker on wherever you want to be. Because I traded many different trading systems. I lost a great deal amount of money. I made a great deal amount of money as well. And more importantly, since 2014, I'm profitable in my trading. And if you want to reduce the amount of time you spend on learning to trade, then this could be something. It could be other stuff as well. You know, there are different things that ATFX offers and that I offer as well that we can help you with. And that's what we can do on this call. All right, so we don't have any questions, so let's move along. We're going to talk a bit about the GBP versus the USD. So what's happening here, we still have, because the economic situation in the UK is severe, there has been talked and there has always been mentions and the idea of having negative interest rates. Negative interest rate is what we have in the euro area, which means that if the bank wants to put money into the central bank, they need to pay a fee for that. So the idea is that it's painful for the banks to store money, so they want them to lend them out. Now, that is something that could weigh on the currency. We have, of course, Brexit, which unfortunately is not really going as good as one would like it to be, especially if you're based in the UK. And the reason for this, I think, ultimately, is that the UK is seeking a trade deal that is very similar to the one, for example, they have given to Canada, right? The thing is this, though, that Canada is not a neighbor of the EU. So sometimes what's going to happen is that it's an invitation, it's certain deals, certain things that they can do, but the EU, when they did this, they know that will never happen because they're so far away. There are limitations. Like, and then, for example, like the UK would like to have good trade deals, for example, with Australia or New Zealand. Well, if you guys ever worked with someone in New Zealand, for example, it is very difficult because they get online at 9 or 10 p.m. At 9, 10 p.m., they are getting ready for work. So it's very difficult to do business with someone when you want to watch TV or do something else, right? And what's the other part? If you want to have a meeting with them, you can also have a meeting really early in the morning. But who wants to have a 6 a.m. meeting? So you see, you have all these geographical limitations. That means that we can give New Zealand an amazing deal. We can give them a deal to do services. Imagine we tell them, look, you can sell financial services into the UK and compete with any European or any UK company. Like you can get regulated by the FCA and you can manage things. Of course, the FCA would never be able to do this because they can't manage someone that is not working at the same time as you are. And it would be very difficult to and limit. But more importantly, the New Zealanders, they start to call people here in the UK, but nobody would be picking up because they're watching Netflix or having dinner with their family, or they're at the pub, or they have been at the pub. So they're not in the mood of talking. So you see, that's why those limitations, it's fine to give a deal to New Zealanders like that because they're never going to be able to take advantage of it. And I think it's the same what's happening here. And that's why the EU doesn't want to grant like Canada-style agreements with the UK. The other thing as well is that from the EU perspective, they have to punish the UK, because if they give them a good deal, then you'll have Greece wanting to leave, Italy wanting to leave, and that is the issue. Now, what's going to happen post-Brexit? Now, that's going to be interesting. I think post-Brexit, UK will probably try to become more competitive. So we're probably going to align ourselves closer to maybe the US, where you can hire and fire easily, even though already today you can hire and fire easily in the UK. You're going to be less red tape, so everything needs to be faster. And that will probably create a stronger economy, I think, in the UK, because that's the only way forward, I think. The problem is this, though. Well, it's not a problem, depending on where you are in the totem pole to some extent. Because what happens is this, is the people that didn't have an education or didn't have like a solid job to begin with, they're still going to be disadvantaged of the new changes, because they will see less labor regulation, so easy to hire and fire, and there's still going to be people migrating here from other countries. So realistically, for the classes that were struggling, I think unfortunately they're going to continue, much like we can see in other places that are deregulated, like for example, like the US, where you have a large portion of the population that can't even afford healthcare. Yeah. So, or in places like, if you ever do travel to Hong Kong or Singapore and places like that, you're gonna see very, very rich, very, very poor, which is of course the same you can see here in London, but it's gonna be more like that across the UK potentially. That's what I think is probably gonna happen. Long story short, then, can we manage? I think realistically, as we come to the end of the year, there's gonna be problems in general with Brexit because of what may happen, and that can create some market volatility. And trading wise, again, because they are looking to reduce interest rates, potentially turn them into negative, you know, I would think that you know, the pound can come back under pressure. But for now, the focus across the world is so much on how things are being not managed properly in the US because of COVID-19, and then in the UK we have things under control for now, and I hope, and I do think we'll continue to have it under control for now. So that's why people are selling dollars, and we could potentially see the GBP trade higher. The pound dollar, it loves to take out a stop loss. Stop loss is the level where people, you know, get out of the market. So if this spikes up to 34, 35, and then just comes back down tumbling and is trading at 127, at one point around Q3, it would not surprise me. And then we'll see what happens because of Brexit. So what would I do now going forward? For now, I'll continue to be bullish, and I'll be bullish as long as you're above 31.05 and buying dips there. Get a question here. How would you recommend to best learn technical analysis? Okay, there are various ways of doing it. There are books, of course. So I can recommend a book. Let me see here. I think if I can find it. I read this book many years ago, and that's how I started. So this one, well, it's called Technical Analysis of Financial Markets by John Murphy. That's a classic book. I think it's this one. No, this is this one. I read it many years ago, and he's also done a book about intermarket analysis, intermarket technical analysis, this one here. You could, of course, do things simpler as well. You know, there's a lot of content online. Now, if you want to walk away, if you want to save time, I strongly recommend this. If you want to save time, I spend a lot of time trying to learn the markets, trying to get ahead. I started trading in 2006, and I actually spent 8 years trying to understand this. And the reason for spending 8 years is because I was doing it wrongly. Firstly, I didn't have enough money in my trading account, which meant that I had to get in and get out really quickly, because otherwise I would lose too much money quickly. Right? I started with 2,000 euros, but I wanted to enforce what we call money management rules, so maximum 1% loss per trade. So effectively, imagine I buy for 100. I buy something and I have 100 pounds in my account, and I buy something, and then I lose 1 pound on that trade, then that is 1%. And what happened here is that I only had the 30 pip stop loss on EURUSD. And the problem is when you start to be the more short-term you are, the more skills do you need. And that's a problem. And I noticed something interesting is that the short-term analysis and the short-term trading I was trading, like for example, buying the EURUSD over the last couple of weeks, or buying gold for that matter, has been super easy. Like, it's super forgiving. You can buy and then you wait and then it goes up. Now, I noticed with my trading, because obviously throughout these 8 years, I had very good periods and very bad periods, or not very bad, but bad periods. So what happened was that I noticed that at all these very good periods, they happened when there was a big move in the market and when there were some big trends. So I realized I don't have to trade on the 30-minute or 5-minute. I don't have to do that. I don't have to get involved in working with these, because I would only make money when there was a big trend on the daily chart. So what I do now is that I look at something like the 4-hour chart or the daily chart. So for example, when gold traded above here at 1817, I bought, and I traded this to the upside. I didn't go all the way up because I didn't think it was gonna go this crazy, but I did buy here. I think I bought here as well, somewhere down here. So I traded some of these sections, like this section here, and I think I traded this section here. I traded silver as well. But what's interesting is that these moves, this is like the price was trading size between July 8 up until July 21st, and then they moved to the upside. So that is, if you have breakouts in the 4-hour and daily, that's what I would be looking for. Now with ATFX, we do offer something called the, this is a website I created for ATFX, and we have something called the Forex trading course. It is a free course, and in there I cover, it's about 4 hours long, I cover what is technical analysis, what is a trend, what is a candlestick chart, how do you trade a trend, where do you enter, where do you exit. I do all of that, plus you walk away with 2 complete trading strategies. A trading strategy is something that tells you, buy here, take profit there, put your stop loss there, and this is how much to risk. Always when you enter the market, you need to know all of these 4 variables. If you don't know, then there's a high risk that you're gonna lose money. So you need to have always that in place, and that is actually what we have here. So if you are interested, and it is all free to get, you just need to have an ATFX account. So how much is it gonna cost you to get an ATFX account, you're thinking? It's not gonna cost you no money. It will just cost 10 minutes of your time. That's it, really. 10 minutes of your time to get it on the ATFX account and fund it. You say, okay, so how much do you need to fund with? Well, as a minimum, to fund an account with ATFX, you would need to have $500 or 500 pounds, 500 euros. In general, though, we do recommend you have at least 2,000 to start investing, because you need that sort of money when you're just doing investment. So that's what you could do, and then you walk away with all of that. So then you don't have to read John Murphy. I read John Murphy. and the best of his ideas are there, and the best of my experience over the last couple of years are there as well. So I hope that helps, Steve. Okay, good. I think we're going to wrap things up. So we covered quite a bit. We covered a lot about the euro, covered a bit about the pound, and I said that both probably the pound and the euro are going to continue to go upwards because of the situation in the US. What I would do, save this page. It's called worldometers/worldometers.info/coronavirus. I'll send it to you. I check this out a few times per week just to see how it's going. And then I try to use that information and merge it with the technical analysis and general news. As well, you have the YouTube channel, which I share with you guys as well. If you do land on it, there's a button, like a subscribe button. And if you subscribe to it, you will get notifications. We don't upload too many videos. Effectively, we upload 2 of these videos every week, plus sometimes like an educational, like an interview and some educational stuff. And the cool thing, you get notifications on your phone when I do this. The live webinars, I do them 9:30 on Mondays and 9:30 on Thursdays. And there's no link here. Rather, what happens is that when I go live, a little window populates to say that I'm live. Okay, good. We're gonna wrap things up. Want to thank everybody here: Steven, Andy, Terrence, Harris, John, and everybody else. Thanks so much for joining me. If you have any questions, as I mentioned before, you got my Twitter, you got my YouTube, and you got that meeting planner, and you have as well access to that course. Thank you so much, and I hope to see you guys soon. Bye-bye.